So you're as excited as I am to cover what's happening this month in the National Housing Market Update now that we're into February. And many people are asking, well, what's going to happen with real estate now that we're through the end of last year and into the spring selling season? And there's really three key areas we're going to cover on this month's National Housing Market Update. And to keep you current, what matters specifically is what happened to rates last month that created some amazing demand in the market, as well as though with new listings and the impact that's having on inventory, where are home values going? And then lastly, how are the headlines right now most likely correct, but they're very misleading and providing probably the wrong context to the information? We're going to cover all three of those in this month's edition of Keeping Current Matters. Thanks for sticking around. Let's dive right in to, as we look at, people do not follow the best leaders. They follow the ones they can understand easily. As you start looking at where do the leaders in this market share information as well, for most of us, we receive it from your local real estate professional or subject matter experts that we receive information online. However, most of those online leaders are actually advertisers. And the challenge is the headlines or the news is that a lot of people are getting their information when it comes to real estate from sources that are not necessarily giving the news. They're just going to share good or bad and their perception of it versus exactly what is happening in real estate. So we're going to break it down very easy for you, because when you look at headlines, remember, that's just telling. Very seldomly are they actually showing what is backing the headline. And that's what we're going to dive in today. Let's start with easily showing you what happened with mortgage rates last month. So as you can start to see is just over the course of 30 days, we started to see a major trend in what happened with mortgage rates, as well as if you start looking at just taking it about 60 to 90 days, we started to see almost a major drop over 1%, which is something that, remember, we have usually never seen an increase of 1% to 2% over the course of an entire year, which is what happened last year. So seeing a decrease in over an entire percent creates an entire new market. And what happened was many people came back out into the market after the third week of January, and we saw a lot of demand as there's limited homes available. And as you can see here from Allie Wolf, she shared a perspective, which is, I wonder if some consumers have worked through the 5 stages of grief of higher mortgage rates. So remember, this is very true. For many of us in the real estate market, if you were an investor, a buyer, or a seller, seeing home values increase at the significant amount that they did over the last couple of years brought about some level of grief for maybe people entering the market. Then all of a sudden you saw the home values increase while rates dramatically increased over a very short period of time, going from 3% to upwards to what we saw, 7%. And so all of a sudden you go, gosh, now the overall payment or affordability has changed a lot too. So for many people, it doesn't necessarily need to be grief, but change is never easy for many, especially when you look at it as a perspective of percentage, meaning the income you take in to afford something as important, as valuable as real estate, while maybe having to give up some of the other things that we enjoy, the nice things in life, but aren't really needs for the accumulation of long-term wealth, like the importance of assets or owning real estate. So as people got through their periods of grief, and as you can see here, the different stages that we saw in demand for real estate based off mortgage rates. So you could see that as soon as we got to about 7% and the upper 6, we saw very limited to weak buyer demand, which is exactly what happened from about July all the way through the end of last year going into November. So now as you start looking at once we see 6.5% to almost down to the upper 5s or 5.5%, the predictions are we're going to see a significant amount of demand coming back into the market. So this is most likely very predictable, but as you can see from that chart below, that's actually the time frame of what happened from January 3rd to February 3rd. So just in a very short period of time of over 30 days, we started to see the mid 6s get all the way down to sub 6, which brought out a lot of buyers back into the market. And now let's move right into the challenge of home values, which is a balance of demand and supply. So I'm going to pause for a moment as you look at this chart, new listings now below previous years, if you see that dot in the middle, that is June of last year, where you heard a lot of people start predicting or sharing their forecasts or thoughts, which really was, oh my gosh, we are going to have a market crash. And here's why. There's going to be so many homes available on the market because people are going to be listing their properties and there's no demand for those homes. So you can see this dotted arrow was the pessimist outlook to the housing market, which remember, I wouldn't necessarily take a optimistic or a pessimistic. I would take a realistic, meaning use data to make your decisions. And remember, the market is changing every single week, month, and over periods of years. That's how we really take into the cycle of real estate. So it wasn't that anybody was wrong, but the problem is if they weren't looking at the data, then they should say this is a fear, but really it's a worst case scenario fear, i.e. crash, but the data is suggesting that there's very limited or the likelihood percentage or chance of it happening is slim to none. So let's continue to follow this just to make sure that if we see the data indicate that it might, we can forewarn you. However, they were completely wrong because this is actually what happened. So as you look at this slide, you saw that now new listings is less than any time we've had, meaning the amount of inventory or new listings on the market is less than any time in the previous 6 years. So the challenge is as we go into 2023, we have very, very limited inventory. And if you look at that stat in the bottom right-hand corner, December of 2022 is 239,000, which is 21% less this year than we had last year. So we may have a little less demand, but as the rates drop, if they continue to do and the significant strong demand comes back out, well, not only is the national market seeing inventories remain low and a seller's market, which means home prices appreciate. But let's dive into really the significance and showing it in an easier way leading to home values, which I'll cover here in a couple slides. As you can see, the overall new listings on the past 7 Januaries, we're only at 318,000 new listings available. So the key here is we need to make sure the data is shared so that way sellers understand that it's not a bad time to list. So for many people, there are so many reasons and situations for why you would make a change. The key is making sure that you're not thinking you can't make a change because of a inaccurate forecast or a belief that bad things are going to happen when they're not. Nobody should rush to sell. However, as you start looking at this month's market update, you can see we're moving into a good real estate market. If you're looking at from home price, meaning it not going down, the challenge is we're still not going to be at a balanced market unless more people decide to sell. So as you look at Mike Simonson, the Altos Research CEO, which is an amazing company to follow for weekly housing update, is that I'm looking at the latest housing data and I see surprising demand indicators, including home price resiliency and supply staying restricted. Who would have guessed that? So again, the reality is we shouldn't be guessing when it comes to real estate. We should be following data, and no matter what, as long as you make the right decision, if good or bad happens, but you're in a good place to overcome the time period, which is most likely 18 months to 3 years max, well, then the nice part is you'll be satisfied with your decision. So a reminder, as you look at performance cars like Formula One, it's not about the straightaways where there's challenges or the skill that's required to be the best, but it's in the turns, the corners. It's where accidents and crashes happen, the balance of understanding what you're doing and the vehicle you're in. So just like real estate, when you're out there shopping or selling, the vehicle to get you to where you want to be is partly your real estate professional and the relationship they have with you, but the other part is the market. See, the one thing that no amazing real estate agent can do is overcome a specific market with just their marketing. But what you can do is prepare and look at the changes. And here's one of the most significant changes at the beginning of this year is that big banks started revising their forecasts. If you look at just towards the end of the year, Goldman Sachs actually shared that their January 10th prediction of home prices across the nation in 2023 was going to be 6%. In less than 2 weeks, seeing the significance of the amount of buyers and demand that came back out, they changed that to only negative 2.6. And remember, this is a overall national market. Many local markets are going to see something much better, and some may see it a little worse, which is why you need to make sure that you are meeting with your local real estate experts, not national advertisers or news programs, because again, Goldman Sachs is in the real estate investment area, and sometimes it might, not that I'm suggesting they do, but it might support some big banks sharing a pessimistic outlook. So then that way they have an opportunity to take advantage of it, as many people will. So as we continue to look at what many people are predicting this year, which was just going to be flat, which would be amazing when you look at the 3 to 5 year change. And if in our correction this go round, there was no home price depreciation on an annual basis, this makes it much better for many people when you start looking at the 1 year, 3 year, 5 year, 10-year outlook of your real estate assets or investments. And as you can see, what we'd be asking is, have home values hit the bottom? Because no matter how you look at it across the nation, in July of last year, we saw a lot of negative outlook on month over month change in home prices. See, the problem is those, whether you look at Case-Shiller, FHFA, Black Knight, CoreLogic, any of these major economists, as you look at what actually happened month over month, the unfortunate challenge for any of the naysayers who want to see something negative happen is that the change in home price depreciation was never greater than the change in home price appreciation, which is what's going to lead to many states and local geos experience year over year appreciation again in 2022, and also most likely in 2023, which then as we look at the inventory outlook and that of seller, buyer, investor sentiment, the challenge is for the investor sentiment, while all these headlines were happening, the disappointing part was you saw a lot of investors continue to fund and put a ton of money into buying real estate for their clients. So while the rest of the American public was listening to headlines and seeing some changes in a correction, opposed to getting out there and taking advantage of it, big banks, big business, and many other people did, even though many times they're the ones in charge of sharing these headlines. So I'm not attacking any messaging, but what I am attacking is the clarity or the context to when we read headlines. See, the challenge is, and I'll ask you this, 67% of Americans say a housing market crash is imminent in the next 3 years. This was from NerdWallet. The challenge with this graph, being somebody who's been in this market for well over 10 years, is that this stat has always been greater than 50% over the last decade. So consumer sentiment, no matter how you look at it, is many people went through some hardships back in 2007, 8, 9, 10. And as we went through a mortgage crisis, a housing crisis, it may never, ever leave our minds to thinking the glass is half full, or just that the worst case scenario, what if, might happen again. And there's nothing wrong with that. When you're investing lots of money and you're making life decisions, you should be very, very careful. The challenge is, though, is that sometimes we have to get out of our thoughts and feelings to work towards our commitments. And for many people, that's the dream of home ownership. That's also the belief of wealth accumulation for you and your family. And we know that real estate is one of the safest and the most accurate risks that we can invest that in. So again, I thank you for your time as you check in on a monthly market update, and as we continue to provide you the weekly market updates, just to make sure that if you're in the market to time it, you have more confidence and you can get ahead of it versus waiting for the monthly market update. But here's exactly what I'm talking about. When you read U.S. foreclosure filings surged 115% in 2022, it looks terrifying, which is why I say headlines do more to terrify than clarify. I won't even read the others because it does not matter. You can find them everywhere. And while these headlines come out, but big banks and big businesses continue to invest their clients' money into purchasing and acquiring real estate, I have 2 slides for you to show you the context to what those headlines are sharing and why it's so important to continue to work together, listen and learn, and spend time with your local market expert, which is a leading curator of real estate data nationwide for land and property data. Today released its year-end 2022 U.S. foreclosure market report, which shows foreclosure filings, default notices, schedule auctions, and bank repossession were reported on 324,237 U.S. properties in 22, up 115% from 2021. Yet nobody added the but, which is the but is what we really remember, but down 34% from 2019. As I move towards, again, this data, you can see that since 2007, 8, 9, 10, 11, when we had over 1 million U.S. properties with foreclosure filing, is that in 18, 19, 20, 21, really for the last 5 years, we saw a continued decrease to almost minimal to none. Now, we had a ton of support from government sanctions, programs, and opportunities, which my heart goes out to anybody who ever has to be in the position to deal with a foreclosure or a financial crisis for them and their families. But as you can see, the context is completely misleading because at 324,000, we're still, over the last 15 to 17 years, we are having less foreclosure filings than 14 of those 17 years. So context is important. And as you look at 1 million fewer foreclosures over the last 3 years, is yes, you'll see percentages rise, but percentages can always be misleading if you don't have the context to what the percentage is actually sharing. And as you can see, the average from 2017 to 2019 was 598,000. 324,000 puts us at 273,000 foreclosures short of a normalized market. So unfortunately, but very fortunately for the families, those that are hoping for something like a crash to come, the likelihood of it is minimal to none. And again, as you look at the executive vice president of market intelligence of Adam, he shared those 18 months of government foreclosure moratoriums as we looked at, the benefits of what the banks were doing and helping homeowners is that, of course, we're going to see an increase, but it's significantly lower than it ever was prior to the COVID-19 pandemic. And isn't that what we're trying to do or have support from banks, governments, is that when we go through a national or a world crisis, is that we have some support locally to help us through it. And as you can see, for most people, that's exactly what happened. And the bottom line is there will be an increase in foreclosures over the next year because we're coming from record low levels. However, the distressed sales during the housing bust led to a cascading price declines, and that will not happen this time. So we must control the narrative, and that's why I am here to share the monthly housing market update with you. For you, your families, I hope that you are off to an amazing 2023. You are doing well. Your businesses are doing great. Your families are safe, and you're dreaming again about where you could see yourself living, the type of life you're living, and where you're living is putting you closer to the who you want to be living by. And I'm always here to help answer any questions. And if you need some help all across the nation, I'll point you to the top 1% of experts all across the world. And as always, keeping current matters, and we appreciate you keeping current with us.